I want to get your take on this because a lot of notes came out. Should you believe the numbers? Should you believe the guide is one headline? A lot of people saying, I'm not really quite sure what we saw in this quarter. How did you take this quarter? And it's also very important to note this quarter kind of is in the middle of the holiday peak. So we're kind of getting a look at the first half of the holiday peak. Obviously, the current quarter is going to show the rest of it.
So absolutely, it was a good quarter, right? That's kind of unequivocal. The real question from our perspective is, what does the second half guide look like, right? And so they raised the guidance, as you mentioned, Frank. But if you do the math on that, really the entirety of the raise was a result of this fiscal second quarter beat. And so they effectively lowered the second half guide. And what they pointed to were three things, right? So they said this issue with the MD-11 planes, you may remember UPS had obviously that tragic incident where they had a crash in Louisville. That resulted in FedEx also going and grounding their planes. There's going to be a cost associated with that. They also said higher incentive compensation because their network is running quite well, and so they're passing some of that on to their employees. So those are the kinds of things that are kind of weighing on the second half earnings here, and then just broader industrial weakness, which is impacting their freight segment in particular, which has more of that industrial exposure. So the net effect, I can understand why the stock market is a little bit confused on kind of which direction to take this. You have to remember this in the context of a stock that's moved up 30% or almost 30% since October. So overall, good quarter, but still a lot to prove.
All right. So generally, though, you're pretty bullish on the company. Your price target is 327. The street average is 287. So you're considerably more bullish than the average of your peers. I want to get back to one of those numbers you were talking about. I want to correct myself. Yesterday, I was talking about the margin when it came to the freight business, and I was looking at the gap and the non-gap. They kind of combined there. It declined year over year by 300 basis points if you look at non-gap. You're looking at the sequential decline when it came to freight margins, and obviously margins are kind of a proxy for efficiency and how you're running that network on the freight. Are you looking at the gap or the non-gap, and how big of a deal is that decline in margins when we know they're spinning off and they're hiring a sales team and they're doing a lot of other things related to that spinoff?
Yeah, that's exactly right. So we look at both. We look at both the gap and the non-gap. We try to make sure that they're not hiding anything in one number versus the other. But you're exactly right. The level of pressure on margins was greater than what we expected. And so what are the implications of that, or what does that mean? Really, that's a function of they're preparing for this freight spinoff, which is planned for June 2026. And associated with that, there are a lot of costs, right? So as you mentioned, they're hiring a sales force. They're taking on a lot of IT expenses in order to allow that business to stand on its own. Those things are expensive, right? And it's clearly weighing on margins. And then you couple that with the reality that we have still a pretty weak demand environment from a freight perspective, especially for those heavy, like oversized goods, the kinds of things that typically move in an LTL network versus a parcel network.
All right. Also took a $150 million charge. So you're saying it's a thing, but it's not the big thing. I think what the big thing seems to be is the domestic strength. You're looking right now at their U.S. ground home delivery volumes up 8%, pricing up 5%. That's pretty impressive in this environment where we're before wringing our hands about the consumer, and now during the first half of the holiday peak, seeing numbers like that, right?
Yeah, so that's absolutely an area where FedEx is doing a great job. On their express side, which is really their parcel business, you can see they're winning business because it's clear that the economy is not growing 8%. So when they're showing revenue that's up 8%, that's really a function of they're doing a good job on pricing, they're doing a good job on revenue mix, and they're doing a good job on business wins. And so that momentum needs to continue. What I think this quarter really proved out was that Express has a lot of momentum going, not only with the revenue mix, but also on the cost side. And remember, for years, this has been a project at FedEx of improving margins, driving efficiencies, what they call Network 2.0, which is really integrating their Express and their ground networks. And this quarter, I think, was a good proof point that they're making progress there. So you referenced our price target, which is a bit above some of my peers. And a lot of that is confidence that they can continue to build momentum in that regard. And there's no doubt that there's a lot of low-hanging fruit in that arena. And you can just look at UPS as an example, right? So UPS has higher margins than FedEx, especially on the international side. And that's where I think a lot of that opportunity is going to come from going forward.
All right, we got to go, but very quickly, you're bringing up UPS, you're bringing up some other transport companies. We also saw C.H. Robinson hit an all-time high yesterday, big trucking and freight brokerage. Is this a read on the broader transports? Do you expect the transports to continue to rally and show strength going into the new year?
Yeah, so the transport sector has been rallying a bit recently. There's a couple of reasons for that. In this case of C.H. Robinson, it's really a lot of people are seeing this as an AI play, and a lot of that has to do with the way that C.H. Robinson structures its business, where they don't really own any assets themselves. It's really more about how do we leverage technology to get better at freight matching. For the broader transport sector, you can see some of these actions that the Trump administration has taken in terms of getting non-domiciled CDLs off the road, right? So that's non-U.S. citizens, restricting the number of non-U.S. citizens who can drive trucks, and that's pushing up freight rates. And so it's early, but it looks like the setup for 2026 is going to be better for transports.